Hi everyone, Mark Thomas from tradeontrack.com here. This is the third video in our series of developing a time-based trading strategy, which is a forex specific strategy that we're doing. And we're developing this for winnersedgetrading.com. In this particular video we're covering money management rules. Now money management is often overlooked as part of an overall strategy, but it actually forms quite a critical part of this particular one. You read the whole article. If you go to winnersedgetrading.com, you can find the complete article, which will describe sort of some basics of money management. And just to sort of briefly cover that again, money management is often just about keeping a set risk percentage per trade. For instance, 2% risk per trade is, a generally accepted value. But anywhere between 1% and 5% is often recommended by experienced traders. Now, I've got some figures here. When I ran the NYTime back tests over a 2-year period, these particular tests are using just a straight 2% risk per trade. Now you can see year 1 was actually quite choppy, a little bit up, sort of level, dropped quite a bit before heading up again. Now this is starting at a $1,000 balance, so the first plot we have here is after 1 month, which equates to a running balance of $11.70 at that time, and it finished off here at $19.39. So the year in itself was profitable. We made about $940. So we not quite doubled our original balance. Not too bad, but our drawdown here is quite significant. I think from my calculations it was around about 39%, because we had this big drop here and that big drop there in February and April sort of added together, and we had a slight increase there, but not enough to bring it up above our previous high. Okay, that's how a drawdown is calculated, from this top here down to there before we recovered again. So that was our low, that was our high. 39% is too much. It's you need to keep it at a reasonable level so that you have a chance of recovering. And if we're getting that sort of drawdown in 1 year, then it's possible we might have another year where our drawdown is much more and we end up losing overall for that year. The second year was actually a lot better. In fact, once again, we start with $1,000 and it's pretty good overall. Had a bit of a drop at the end, a 15.5% drop at the end, but we still finished at 4,700, so we quadrupled our account balance overall, nearly 5 times. So that's a really good year using a straight 2% risk per trade, excuse me. So the maximum drawdown in that year was 15.5%. Then I got into, in the article you can see the full details of that, but we got into a risk percentage that varies based on how well the system is going, basically. So if it's in a losing streak, we reduce the risk on each trade. We reduce it by 1% each time we have a losing trade, and we might come right back to 0 when we're basically not trading at all. Then if we start winning again, it increases the risk percentage by 0.5% each time, up to a maximum of 4%. So you can see our risk varies from 0 up to 4. We started off at 2.5, but it doesn't really matter where you start it. That's our range, from 0 to 4. I recently heard a guy sort of describe a similar system, and he sort of equated to driving a car. If you're going really well, you put your foot on the gas pedal and accelerate. That sort of equates to sort of bumping up the risk level. If you come across some danger, if things are looking bad, then you've got to take your foot off the gas and hit the brake pedal. So that's what we're doing when we start decreasing our risk right down to 0, which would be basically coming to stop in a car. once things are looking good again, we start to accelerate again. So that sort of mimics, you know, that. And we will look at a chart using the new money management rules, the variable percentage rules. You can see year one is a lot more consistent. We didn't have that big drawdown. We have actually increased our overall return. Instead of just under 3, we're up to 3,700, and our drawdown is much better. Okay, I think it's around about 13-14% drawdown there. Year 2, the return actually dropped. Instead of being up around 4,700, it's come back to about 2,900, but it's still fairly consistent, and we've still got about the 15.5% drawdown. So overall, I'm happier with this strategy rather than a straight 2%, because we've got a more consistent return per year. Overall, the dollars are about the same. You can see in this this second strategy, we've made about, we started off with 1,000, so we've made about 2,700 there, and about 2,000 there. So that's $4,700 in 2 years. 4,700, and in the first instance, where we had a 2% risk for each trade, we made about 900 on that one on the first year, and about 3,700 on the second year. So overall, that's about 4,600. Alright, so 4,600 on that. The second method, using the more advanced money management rules, we made about 4,700. So, you know, neither here nor there, but a more consistent result was definitely had using the variable risk percentage. Check it all out at Winner's Edge Trading. Thanks.